Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. US futures point higher after Wednesday's rally as Fed Chair Jerome Powell keeps rate cut bets alive, describing tariff inflation threats as transitory. Next up, the Bank of England, where policymakers are expected to keep rates on hold and stick to guidance for gradual and careful cuts. Ukraine's president agrees to a mutual halt to attacks on energy assets. EU leaders gather in Brussels today to talk defence spending, Russia and Ukrainian security.
OK, let's talk about where we are with these markets. Clearly, we're in a post-Powell environment. European futures are a little negative this morning. US futures are a little positive this morning. Pay your money, you take your choice on which way the rest of the session is going to develop. US futures are fading, I would argue, as we speak. The real story for me this morning is copper. Keep an eye on that. That is a major input to the global economy. We are through 10,000. There's talk of tariffs. Keep an eye on that one. And not much movement out of Turkey this morning. Obviously, a lot of sound and fury yesterday. Today, that accounts for little. The countdown to the opening trade starts right now.
The fact that there wasn't much change, I think that's partly because, you know, you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. You know, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Jerome Powell speaking last night, talking about the decision to leave rates on hold, basically indicating the Fed could cut or it could hold. It's pretty comfortable with where it is right now, but it simply doesn't know where it's going. And I think that is the big problem that markets face. The bias seems to be that he was dovish, but really?
Yes, I mean, it depended if you had those hawkish expectations going in, perhaps, didn't it? I mean, my two favourite words of yesterday were inertia. We heard Jerome Powell using that one, and transitory. I mean, who saw that one coming back so quickly? I feel like we're all more scarred than he is with the use of that word. But inertia, certainly a focus. My favourite line from the press conference was when he turned to the journalist who asked about this, and he then went on to that comment about inertia. He said, well, frankly, what would you put down? What would you put in your dot plots? Yeah. Because they really, pointing to the huge amount of uncertainty, a high degree of uncertainty. He talked about that often. And they, just like us, they don't have all the answers as to where Trump's policy is going to take us. But on transitory, the base case then is that tariffs, it is OK sometimes to look through some inflation if you think it's going to come right down. And once again, we're back to a point where people are saying, OK, that might be technically true, but what about second-round effects? What about the secondary impact of tariff inflation on other things? And will we be in another cycle where the Fed underestimates that?
And that's the problem. And we're back in a position where, despite everything, Powell, on balance, sounds slightly dovish, and the market kind of takes that on board. But if we are in a world where inflation comes back, he is going to need to be much more hawkish. And I wonder, kind of, are we going to be in a situation where he has to rush to produce that kind of a narrative again and completely catch the markets off guard? We're in such a difficult position. Trump isn't helping either. So he's throwing his weight into this as well, saying basically you should cut before tariffs come in. Powell's basically saying, I can't do that because I need to see what the economic effects are and understand those. And I wonder how long before that fight becomes more significant as well, and what impact that has at the front end of the curve. There's a lot going on here. But the market wants to get, it's OK. He's talked about nice things. We're going to we can move on from
the market not focusing on any longer-term questions about a lack of credibility and a lack of intention to fight inflation, and instead saying, OK, that means there's some rate cuts coming. We like those. We were expecting those, and they're still there in the dots, so happy days, and stocks went higher.
The dots are amazing because basically what he said was, we don't know. So basically, we're just going to sit on the dots we have. Rather, there seems to be this bias to activity. Basically, this is masterly inactivity. We're going to sit, we're going to wait, we're going to watch, and we're going to figure out what's going to happen next. Let's
talk about activity of a different nature. Let's talk about the UK. We'll go to the conversation about the Bank of England, but just to mention what's going on the unemployment front. Of course, a lot of problems with the unemployment data, but I'm looking at the unemployment rate at 4.4%. That data just dropping here for the UK. That's exactly as had been expected. And I'm looking at various figures on wages, average weekly earnings 3-month year-on-year 5.8%, again exactly as had been anticipated. All of this then feeds into a Bank of England conversation. Lizzie Burden, you saw her last hour on Daybreak. She's hung around in the studio just long enough to tell us a little more about what to expect from the BOE then, Lizzie. What are our expectations?
Yeah, look, these jobs numbers exactly bang in line with expectations, and it kind of feeds into this sense of caution around the second round effects that you were just talking talking about in the US context, but in the UK context of Trump's tariffs and whether inflation expectations are going to get out of control, whether you're going to see wages and prices rising off the back and the BOE therefore needing to be cautious. So the expectation today is that they are going to hold rates, but that the cautious tone will continue. It's exactly what we've heard from the likes of Dave Ramsden recently, the Deputy Governor. He's kind of seen as a bellwether on the committee. And they're also likely to keep that guidance from February that cuts are going to be gradual and careful because of these concerns. But in terms of the path ahead, I would just note we're not going to get any forecast today. We're not going to get a press conference. You might get a hint that the inflation and growth outlooks from last time are too low, but not an official increase in the outlook. So at the moment, you've got traders pricing 2 more quarter-point cuts this year.
That's true, but if you look in the options market, actually the market is pricing in bigger cuts. And I'm wondering where the impetus for that comes from. Is it coming from the economic data, or is it coming from places on the MPC? Is it coming from Cathy Mann? Can we expect any more surprises from her?
I would never rule out surprises from Catherine Mann. So, of course, she went last meeting from Archhawk to Archdove. She surprised the markets. And since that meeting, now she's been emphasising the need to keep policy restrictive. There have been some economists predicting a 3-way vote split today. And I think what's interesting is, the Governor, Andrew Bailey, said, don't read too much into the vote split. Let's see if there's a surprise and markets do again.
He doesn't want it to be a signal for markets, does he? So we certainly didn't last time.
He told me once that it should be a signal. He says it is.
Not last time.
Okay, not last time.
But he wants it to be.
Yeah, precisely. So I have had the conversation with him when he went, oh yeah, this is definitely a kind of communication tool. This is what we're signalling. Anyway, we'll park that one, as you say. Maybe meeting by meeting is where we should think about that one. So EU leaders in the next few minutes, I suspect, will be getting into their cars and making their way over to the Council building in Brussels. There is a leaders' summit taking place there. What they are going to be talking about, I think largely it's going to be defence. Clearly, how Europe plays a bigger role in the Ukraine-US story is going to be an interesting aspect, side story maybe to this. We are going to have input today from the Ukrainians, and I think it'll be interesting to see what Zelensky has to say on that front as well. But the big story this morning really is about defence spending. And we saw this proposal yesterday being pushed out that the Europeans wanted to be able to defend themselves on their own 2 feet, basically, by 2030. That's a very short timeline. There's a lot of money going to be spent on this. The UK is going to be excluded from this process until a deal is signed, basically, to allow them in. This feels very French at the moment. And it's going to be really interesting to see how achievable all these targets are and whether or not actually Europe can work together in the way that the French maybe are proposing to deliver this outcome of being able to defend itself.
Yes, and so one thing, so very, very much that's the focus today. It's a focus on defence and defence capabilities within Europe. It is a focus on the money and how it's spent, as you say. There is also a focus on Ukrainian security, and the sanctions brings Europe very quickly into that conversation, doesn't it? Because Europe still has very tough sanctions. And actually, we've seen a draft of the communiqué that's expected from this EU leaders meeting, and it is expected to say that Europe is ready to impose more sanctions. And how at odds does that put Europe with the United States right now? Europe wants to see Ukraine as what's been described as a steel porcupine, so fully supplied with arms, with an army that is credible and able to jump back into action, whereas Putin wants to see it with reduced access to arms and with limited numbers. So we'll see whether we are on very different pages across the Atlantic and how that leaves the EU leaders on the Ukrainian question.
A steel porcupine. I'm imagining that. I just want to point out as well that Keir Starmer is going to Barrow-in-Furness today, Royal Barrow, apparently, from now on. He's going to be laying the keel for a new dreadnought nuclear submarine, which again speaks to the UK's role in terms of the nuclear umbrella and how that is going forward.
That area, a big focus for the defence sector as we see that start to boom, start to coalesce, start to come together once again across Europe.
Let's talk about the guests we've got coming up on the show. We'll talk about the defence angle. We're going to talk about what's happening with the Fed. We're going to talk about what the implications are for the bonds markets. Lauren Goodwin, New York Life Investments Chief Market Strategist, is going to be joining us, as will John Neal, Lloyd's of London CEO. We feel like we're in a very uncertain world right now. Lloyd's is probably a good company to talk to about what is happening there. And Madeleine Runner, DWS Portfolio Manager, joining us a little bit later on to give us an outlook on what is happening with the equity picture.
Let's also talk about some of the other things on the agenda. We've mentioned the EU summit. That's taking place today, so all of those EU leaders will be descending for that. We'll have the Bank of England rate decision we've mentioned. US jobless claims, of course, on the list because it is a Thursday. We have the ECB's Leroy speaking a little bit later on. And something that's not on there because it happens during our programme, so it's not after the show, but it happens during our programme. SNB rate decision, Riksbank rate decision. Both of these central banks were early when it came to cutting rates at the start of the cycle back in 2024, Guy. What are we going to see this time around? I mean, SNB seems to be the area where it's described by UBS as a bit of a coin toss, actually. So although there are expectations that we get a cut of 0.2 to 0.25% and of 0.25%, that's not certain. So we could see some volatility around that one at 8:30 UK time.
Are we going to go back into negative rates? The answer increasingly feels like the answer to that question is no. And this could be the last rate cut. So we get it today. Is that the end of the cycle for the S&B?
And is now when you want to use that last rate move today? Are things bad enough that you want to use your last one on the way to zero today?
OK, let's talk about what else we need to know this Thursday morning. Israel has said it has started what it is describing as a limited ground operation in Gaza. The Israeli army says troops are looking to create a partial buffer between northern and southern Gaza. The operation follows airstrikes across the strip that the Hamas-run health ministry says has killed more than 400 Palestinians. Some of the world's biggest pharmaceutical companies are warning that the UK is becoming, quote, uninvestable, denting the Labour government's hopes of driving economic growth via the life sciences sector. The likes of Astra, Gilead, J&J are arguing that drug pricing rebates and the system around that whole process are basically compromising innovation and investment. And Nvidia is aiming to spend hundreds of billions of dollars to buy US-made chips and electronics over the next 4 years. The CEO of the company, Jensen Huang, telling the Financial Times that he is aiming to have his firm's latest chips manufactured in the United States in fabs owned and operated by TSMC and Foxconn. Huang is hoping that the move will add significant resilience to Nvidia's supply chain. It'll probably go down quite well in the White House as well.
Yes, absolutely, and probably would have gone down quite well in the White House under its previous administration. Yeah. I mean, it's worth pointing out the continuities that we're seeing here. The amount of chip production coming back to the United States. The Inflation Reduction Act was, of course, a crucial driver of that during Biden's tenure, and now under Trump, of course, this takes on added meaning, and the tariffs mean that there's added impetus here. We had seen this as something that looked set to drive futures higher in the States, and we do see a bit of that, but Nasdaq futures just up 0.6%, so we'll see whether that story gains further traction.
We'll watch for that. At the moment, we've got European futures negative, reacting maybe a little bit to yesterday, but we had Powell coming through later on in the session as well, so we need to factor all of that into our thinking too.
Absolutely. We'll certainly be focused on the defence story then for you today. Coming up, we'll head to Brussels, where EU leaders begin arriving for that summit, with the bloc's defence spending plans firmly in focus. Plus, the SNB and the Riksbank break their decisions during our 2 hours of programming. It's a big day for central banks. We might actually get some movement in an interest rate today. We might. We're not sure. We'll see what the SNB does. Up next, we'll talk Fed, central banks, fixed income, all of that in conversation this morning. Lots to digest when it comes to the Fed. President Trump's views on what the Fed is doing, of course, as well. If you have questions, if you want to get involved, IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
There's always an unconditional possibility of a recession. The economy is strong overall and has made significant progress toward our goals over the past 2 years. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us. Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas. Uncertainty around the changes and their effects on the economic outlook is high.
Uncertainty seems to be the word of the moment right now. Fed Chair Jerome Powell speaking last night, talking about the idea that maybe we're okay where we are, we could cut, we could hold, but in reality, we don't know yet. And that takes us to Valerie Teitel, who is here to provide us with some clarity.
Guy, the equity market had a bit of a relief trade as Powell was speaking because he didn't echo this recent pessimism on the U.S. economy. He still characterized the U.S. economy, GDP growth, and the hard data as pretty solid. He even went to downplay the recent drop in the soft survey data, saying consumer sentiment weakening doesn't always feed through into weakening consumer spending. They are going to wait to see any sign of that in the hard data. They also revised their GDP growth numbers lower, but I would note their 2025 GDP projection at 1.7% is still bang on the long-term trend for the U.S. economy. So they're not necessarily forecasting below-trend growth with their GDP revisions. I want to go over one quote that he said over and over again, just talking about how the Fed is in no hurry. If you flip on, I can read this one for you, saying our policy is in a good place to react to what comes. The right thing to do is to wait for greater clarity about what the economy is doing. Is that hawkish? Is that dovish? I think that's still up for debate, Guy. But one person who took offense to this was President Donald Trump. He was out on Truth Social a few hours ago urging the Fed to cut rates because with his tariffs coming in on April 2nd, they will need to ease the transition for the U.S. economy.
It's no fun if you don't pick a side, Valerie. You know the game. You've got to be dovish or you've got to be hawkish. It's got to be one or the other. It can't just be right down the middle. Valerie, great stuff. Thank you very much indeed. We're joined now by Lindsay Rosner, head of multi-sector fixed income investing at Goldman Sachs Asset Management. Pick a side. What do you think? Dovish or hawkish?
So I'm going to say there was a little bit of both. There was something for everyone, okay? So I'll be diplomatic there. The dots actually were pretty hawkish. I think what's interesting is the median dot people are holding on to said 2 cuts for this year still.
Yep.
But if 2 participants had shifted their dots, we would have been at 1.
Yep.
That's actually hawkish under the hood of the car. But when we got into the presser, that was resoundingly dovish. So net, I think the presser pushed things into the dovish place. And really, we believe it was pretty masterful by Powell to be able to pull off preserving optionality once again.
OK, so where do we go? OK, I'll continue with the car metaphor. Can I park the car for now, put
Please.
the Fed to one side, and we'll wait for tariffs? That's basically what we're waiting for here.
We are. And the date that's really important is upon us actually pretty soon. It's April 2nd. April 2nd, so much has gone on, we kind of forget what we were expecting on April 2nd. But to refresh, we're waiting for this American First Trade Memorandum. That is supposed to be really the manifesto on what does trade look like for America writ large. And that's pretty big, and that's going to be meaningful. We're also going to figure out what reciprocal tariffs look like. And April 2nd is also the kick the can from March to April for Mexico and Canada tariffs. So there's a lot going on.
Yep.
And I think there's a real potential for the market to maybe not get what they want.
And the word reciprocal, good morning to you, Lindsay. The word reciprocal is used here, but increasingly in inverted commas because it seems to mean so many different things, certainly over in the United States and in the White House, because on the one hand, it means, sure, putting the same tariff on another party that they put on you. But it also seems to take into account tax regimes that the administration doesn't like, and maybe even low-wage environments that the administration doesn't like. So we could get a lot of surprises on April 2nd, I suppose, is the point.
I think that's exactly right. And that's where there's room for disappointment or the market potentially being upset because we're waiting for a playbook. We're waiting for definitions for exactly the point you just made. What does reciprocal actually mean? And I think if the market doesn't get a really clean set of definitions, I think we could see some more volatility like we saw 2 weeks ago.
And Powell went out of his way yesterday to say that it's really difficult to work out what impact tariffs will have on prices. Maybe months down the line it might be easier. But at this point it's difficult to calculate. He says there is some impact from tariffs on inflation, but not sure exactly to what extent. Once we see the tariffs, can we sort of do those sums? Can we work that out? Will we have a better understanding of how inflationary or not this is going to be?
Yes, if we get that playbook on what tariffs are, we can do the math. I think there are a lot of participants in the market that feel very comfortable doing the math. We just haven't had the inputs to do the math that we need to do.
So what do you do in the meantime? Do you just sit on the sidelines? I read your note this morning. You've got to be careful which bonds you buy. People seem to be piling into cash right now. You can understand why. It gives them a lot of optionality. What do you do?
Yeah, so on the cash point, I mean, we've got a lot of central bank action coming. In some cases, or in most cases, we're either in a hold or a cut, and maybe the final cut. that would give you confidence to be in some of those kind of cash instruments. But for us, what's far more interesting is looking at the relative value moves that have happened recently. Specifically, the moves in Europe make us feel like we want to be more in a steepener. Specifically, we think term premia is going to increase, but the tariffs make us think that a steepener is a better way of playing it rather than directionally short. And then from the credit side, what we've seen in the past 2 weeks is Europe really outperforming the U.S. And so when we saw this moment of volatility about 2 weeks ago, we actually added U.S. credit. That's doing well. And I think if it does too well before April 2nd, that could be a good opportunity to pare some back. So it's not, spring break yet. It's not time to just sit back and wait for April 2nd. We're active managers. I think that's what you need to be in this market, and we will be dynamic.
OK, so steepeners in Europe. Thinking about Treasuries and how they responded yesterday to the sort of reaction function in Treasuries, I suppose, how they responded to Powell, could you have seen a world where he didn't sound too worried about inflation and he used the word transitory and yields were spooked and we saw much higher yields in the US? We didn't necessarily see that response. Maybe that was a little bit surprising, given how scarred we've been from the recent years.
Yeah, I think transitory brings up a lot of feelings. It's a word that we had before that didn't really play out in the short time frame that normally people define transitory to be. But I think it was that when you looked at the SEP dots and you looked at the forward years in terms of inflation, they did not represent a bump. And so the way that the forecasting read, I think, gave comfort that the Fed can play through.
Right.
For now. Now, that could change.
So the market's focusing on the sort of unofficial forecasts of the Fed, because they're not a commitment, they're not really a forecast, are they, the dots? But focusing on that rather than the views of just one person, OK, he's the chair, but sort of saying we're not going to worry too much. If he's not that bothered about inflation, others on the Fed will be more worried about sustained inflation.
Well, I think what you got was a coalescing around, kind of to use Powell's words, it's uncertain, we don't know right now. But there seemed to be enough comfort in terms of pausing. And that was the big takeaway.
Let's come back to Europe for a minute. I know we're bopping around either side of the Atlantic. Germany has a lot of fiscal space. It can do what it needs to do on defence. Italy doesn't. Spain doesn't. The UK doesn't. When you look at other bond markets around the Bund market, what do you see? How significant is the risk? If Rachel Reeves gets it wrong in terms of the upcoming spring statement, the kind of the budget that we're about to see, or non-budget, how big a risk is there that the European bond markets could be blown off course quite quickly?
Yeah, I think we've seen the big volatile moves that we're going to see already.
Okay.
We had humongous moves, obviously, in the markets.
That started in Bunds, though.
Right.
But it's gone to other markets that don't have the tolerance for higher yields.
Right.
And I'm wondering if there's a danger that we're kind of at the point where extra spending is going to cause problems and the market is going to get a little bit freaked out by the supply it's going to see and the debt levels it's dealing with.
Yeah, I think it's a time and distance thing. So as we talk about what the spending could be, that spending doesn't start tomorrow. And so I think we've got some time for the market to get more comfort around what that would look like in the future. And therefore, this concern of some really big volatile spikes, I think, is less likely.
Lindsay, thank you very much. Thanks for joining us. Lindsay Rosner, Head of Multi-Sector Fixed Income Investing at Goldman Sachs Asset Management. Thank you for coming to see us as you pass through London. Coming up on the programme, US stocks get a bounce from a reassuring performance from Fed Chair Jerome Powell. We'll discuss the market's reaction from a stocks perspective. Lauren Goodwin joins us. This is Bloomberg. Welcome back, everybody. This is the opening trade. What are we expecting then from the day ahead? This is the picture, the setup in bond markets. We've had US markets close, of course, with the Japanese market. They're now reopened as we've come into London trading hours. But this is the picture then for European bond markets. We see those yields down a little bit, a bit of buying on German, French, Italian debt. Big questions around defence. They will be asked a lot at the meeting of European leaders today. So that's going to be a focus for us as we try to move on from the Fed meeting towards Bank of England meeting. funding and via those defence conversations in Brussels. Let's have a quick look at European futures. We have a picture on US futures that looks pretty buoyant, actually, after yesterday's rally on US stocks. European stocks were pretty good yesterday as well. European stocks pausing for breath, though, this morning. Euro Stocks 50 futures down, but just a touch, down by 1/10 or 2 of 1% this morning. In fact, let's have a look at those US futures, because as we were mentioning earlier on in the programme, the Nvidia story, FT had an Nvidia story talking about a large amount of investment in the US and in chips manufactured there, and that's being talked on the Markets Live blog as something that has been boosting Nasdaq futures. That picture not looking as rosy as it was, but still up by 0.5% on Nasdaq futures this morning. Joining us now, Lauren Goodwin, economist and chief market strategist at New York Life Investments. Lauren, very nice to have you with us. We've talked a lot about the Fed, but let's do that again, but in a different context. In the context of stocks, stocks really liked what they saw yesterday. We saw stocks rally because they were comforted, I suppose, by some of the things that Jerome Powell said about the economy and about a seeming keeping open the door to rate cuts from the Fed. Did that make sense to you? Did the stock's response make sense to you?
It does make sense to me, because Chair Powell's, I think, goal, his message was essentially to say as little as possible, to acknowledge that there's uncertainty. But after 9% down in the equity market, a little bit of stability, both in the data and from the chair, does make sense to us. Now, my key concern for the equity market over the next really week and a half is that these sources of stability are likely temporary. From the Fed's perspective, their mandates are moving in opposite directions. That's still in tension, still brings a lot of uncertainty to the market. And then the other key source of policy uncertainty, tariffs, other policies out of the Trump administration, these are still very much at play. And so up until April 2nd, we may have some of this buoyancy as we wait for more directionality. I think it was Chair Powell's role just to give very little direction at all.
And the backstory here, of course, is we've seen a correction in US stocks. And now a lot of people ask, well, is that it? Is it a correction and we bounce? Do we buy that dip? Or do we head into something that's more like a bear market? We still have April 2nd hanging over us and all the detail that we'll get there. But what are you looking at then to tell you whether to answer that question?
What's difficult about tracking the course of the market from now is that, from my perspective, I think until you have policy uncertainty really clear, it's difficult to call a bottom on the market. And so we're looking at April 2nd as well as later that week when we see the jobs report out of the U.S., where we'll see the first sort of instances of hirings and firings out of the federal government as still key sources of looming uncertainty. So in the very near term, we're staying put, more or less, when it comes to buying and selling out of the equity market. One thing I will say, though, is that I believe that a bear market levels, let's say down 20% total in the U.S. equity market, are a key signal for both the Fed and the federal government in the U.S. to pull back from those levels of uncertainty. And so I don't anticipate that we'll hit those crisis or real concern levels out of the U.S.
Is the U.S. still exceptional? Is its equity market still exceptional?
It is still exceptional. But the sources of that exceptionalism are innovation, sort of ease of doing business, et cetera. These things haven't changed. Is the U.S.
Are they priced correctly?
I believe so.
Okay.
I believe so. What I will say, though, is that when we look at some of the dynamics out of U.S. policy and sort of the next steps, let's say, for the equity market, I think that some of those sources of exceptionalism, like what we've seen out of artificial intelligence, those have forestallen a somewhat difficult conversation about asset allocation over the past couple of years, which is that the sort of macro underpinning of not just the U.S. economy, but the global economy has changed. It's become more capital intensive. It's a different economic model where we see more redundancy, and that likely requires different sources of allocation. If we're really, really honest about the last 15 years in the market, the ideal allocation would have been 90% U.S. growth equity. I think that balance has changed meaningfully.
To what?
In equity markets, a couple of ideas. In equity markets, we're focused on still quality. We still like large caps globally, but more balance. That means more balance between the U.S. and the rest of the world.
So it was 90 before. What is it now? Is it 70, 60, 50, 50? Just give us kind of how far has the pendulum swung?
I think it's swung meaningfully. You're probably looking at it within an equity portfolio, and here I'll just give the example of a U.S. investor. We see many U.S. investors that instead of the, say, 20 to 25% ex-U.S. equity, they're invested between 3 and 10% ex-U.S. equity. We think that they should close that underweight. So that means in many cases more than doubling your international equity exposure to closer to 20, 25% of the portfolio. It's a meaningful change. Yeah. But that change, I should say, it's not just about some of the positive catalysts that we're seeing, for example, with defense spending out of Germany, et cetera. It's on a tactical basis also just about differences in the capital market. Interest rates have moved lower more quickly on the continent, and that's created a cyclical boost in financials and industrials. That was causing outperformance for Europe relative to the U.S. months ago. Many U.S. investors missed it. But that economic cycle benefit is a source of resilience for the continent as well.
And Lauren, what does the reshoring trend mean for U.S. stocks? We were talking about a story about Nvidia increasingly wanting to produce in the United States, and that might do specific things to their share price or the share price of the companies that they work with in order to do that, or the U.S. supply chain might benefit from that. But broadly for U.S. stocks, because the arguments around globalization have been, lower inflation and all of those, and then some read across back into US stocks, no doubt. So what is the read across into the broader stocks basket from reshoring all of this production?
Yeah, I'm glad you're asking this question, because there's been so much focus on tariffs, and one of the things that we heard earlier is, tell me the tariffs and we can do the math, et cetera. And I don't have the same view. I think that the world has really changed in terms of the global economy dynamics. And it's not just reshoring, but also electrification, digitization, the focus on artificial intelligence. When you put these together, these are incredibly capital-intensive trends. And so if you think for the next 2 to 3 years, that's more likely to be inflationary than not. You're creating redundancy, you're investing in a meaningful way. And again, that capital-intensive investment, it requires more upkeep, it requires more updates, especially digitally. And so we are big buyers, big supporters of the sort of infrastructure trend around these capital-intensive investments, energy infrastructure, digital infrastructure, and that likely means that inflation is stickier as well. And so we're very focused on income generation in equities via dividend builders, but also in bonds. The quality that we're seeing in both public and private credit in the high yield space is, from our perspective, a really nice 2 to 3 year buy and hold to navigate some of the volatility we'll likely see in the equity market.
Buy and hold. You don't hear that very often in an uncertain world.
Divvies are coming back.
Well,
I wrote that down.
Kriti's been talking about that for a while, to be fair. How much volatility should I tolerate in my portfolio? You talk about sort of buy and hold, but I'm curious as to, does my tolerance need to be higher? Do I take less risk, or do I tolerate more volatility? I'm wondering how I should think about, and different people will have different attitudes towards this, but nevertheless, there has been this kind of one-way traffic for years and years and years. And you talk about the fact that US investors are trying to get their heads around the fact they've got to reinvest in the rest of the world. What else are they having to get their heads around right now? How big a shift are we seeing in terms of the tectonic plates at the moment?
So we're not seeing a shift in allocation in a meaningful way yet. In fact, what I think is really interesting is that uncertainty is causing a sort of wait-and-see attitude among investors, really globally when I have conversations with clients. But this type of tectonic shift, I think, does require meaningful allocation change. And so we've talked a little bit about balancing from a geographic perspective. One of the areas where we're not recommending rebalancing is in terms of size. We typically don't see small caps, for example, really benefit from changes in the global environment, including inflation, unless you're seeing the economy really re-accelerate, and that's not what's happening. And so another source of rebalancing we're encouraging is to take some equity-like risk in credit. I mentioned a 2 to 3 year buy and hold. The improvements in quality that we've seen in the high-yield asset class, both in the U.S. and Europe,
You're not concerned about
meaningful.
Pricing there?
Oh, of course. Of course. In fact, and we've already started to see spreads widen a bit, but that's why it's a buy and hold. If you're not worried about those bonds defaulting, then hold until maturity and clip that coupon all day. 6, 7, 8% out of a high yield bond.
You get a recession, that game changes.
It can. in the sense that you'll see flows in and out of the asset class meaningfully change. So a buy-the-dip opportunity might be stronger in the event of a recession. But if you expect, again, quality assets not to default, even in a slowdown, that's not something that we're meaningfully concerned about. Now, focusing on quality within the asset class is incredibly important there. But that income generation opportunity, again, looking out, I think is meaningful. The other thing that we're really focused on is how do you build in sort of volatility and inflation resiliency? And so we're seeing even in more sort of like, let's say, risk neutral, risk averse portfolios, a little bit more allocation to inflation aware asset classes like commodities and real estate. And also some geopolitical hedges, gold, a little bit of digital currency as well as energy. Again, just to acknowledge that we're not just seeing volatility, but also inflation volatility globally.
Well, great to see you. Come back anytime. Lauren Goodwin, economist and chief market strategist at New York Life Investments. Thank you very much indeed. We're going to carry on the uncertainty conversation. Yes, there is a theme in this morning's programme, and it is definitely uncertainty. Lloyd's of London posting a 2024 profit before tax of £9.6 billion. That is down roughly 10% on a year earlier. I have to say the key metrics in terms of profitability have, though, improved. We'll find out why. John Neal is the group's CEO. He is going to be joining us next. This is Bloomberg. Let's carry on with the uncertainty conversation. Lloyd's of London posting full-year earnings, I'll get that word out, earnings with profit before tax and investment return. That's a little lower than a year earlier. The insurance and reinsurance market says it's seeing an increase in premiums written in the market. The key metric when you need to think about these businesses is the combined ratio. And that is improving, i.e. it's going lower, i.e. the profitability on the businesses being written is improving. Joining us now to discuss this is John Neal, the CEO of Lloyd's of London. Good morning.
Good morning. You don't need me. You've just explained it better than I can.
Excellent. You're going to add colour. We live in an uncertain world. It's getting more uncertain, it feels. I'm assuming that's good for what you do.
It is. I mean, we have to be careful how we say this. So a riskier world for us is net good. It means that we've got to do our job. Our job's to help government, help businesses, help individuals in that uncertain world. And, you know, in a world where you've got financial uncertainty, where are interest rates going, where's inflation going, we talk about systemic risk, we talk about war on land, we talk about climate. They're all issues that we understand, and they are all issues which are insurable. So our job is to get people to understand how our balance sheet can take that risk, and then being fair in the way in which we price for it.
Can I just talk about sort of realised uncertainty, i.e. think bad things that actually happen? Are more bad things happening, or does the world just feel more uncertain? I'm wondering kind of what the reality is in terms of what you see.
So the answer is both. You know, when we look at climate, the frequency and severity of natural peril losses is off the clock in terms of the increase in frequency and the increase in cost. So sadly, when you look at California and the wildfires, which is a terrible event, fires and floods are ever more frequent. We do understand that. We can insure against it. So you've got that on the one hand, and then clearly on the other, we are seeing risk we've not seen before. You know, we've not seen war on land for 70 years, have we? So that brings a completely different set of challenges.
Yeah, in Europe, it's a bit of a novelty, or certainly in that part of Europe. What about the impact of things like California and all of the hurricanes that we had in the United States? The impact on people's willingness to take out insurance, because we've seen a move also towards self-insurance. So what's the tipping point between it driving more demand for insurance and actually people saying, well, the price of insurance is so high, I'm not going to?
I think where people see risk, so there is twice as much insurance cover bought in the US as there is in Europe. Because natural peril loss is just a bit more frequent there, then people tend to buy more insurance. So you're right, there is a responsibility on our part to explain the value proposition more clearly. Otherwise, you're right, people just retain too much on their own balance sheet. And then if something terrible does happen, then I think it can be catastrophic for the economy. And we can't rely on government all the time to bail us out when something difficult happens.
Yes.
So that's my point of us better explaining the value proposition of what we do.
That's interesting. So not relying on government, but at the same time, I know we've talked in the past, John, about needing new partnerships, and sometimes that does mean partnerships with government entities to put insurance sort of safety nets around things. I mean, where do we need to see more of those new partnerships to help the sums add up?
So I'll give you two quick examples of where we've been doing things. So you think of the Commonwealth related to the UK. We put together a disaster resilience vehicle for some of those smaller island states, which involve the United Nations providing some upfront cover and then the insurance industry sitting behind it. So you've got some government-related support at the front end, which is allowing insurers to provide much more cover, up to 30 times the cover that's previously existed. You've got the same issue in somewhere like New Zealand, where earthquakes are very prevalent, where government provides the first bit of cover with a bit of support from us as to how they measure it, price it, manage it, and then we back it up. So I think that concept of public and private partnership has needed to be revisited. I think it's starting to happen, which is good.
Are insurers better at what they do, or are interest rates just making life easier?
Both. I think we're much better at helping people mitigate for risk. We understand risk, we can measure it, we can help people manage it, so we can price it. So I think we've got a lot better at what we're doing. But don't get me wrong, I mean, we do sit on a lot of assets. You know, 25% of the world's assets in financial services sit with insurers.
Yep.
So interest rates have been helpful in giving a better return to the investor.
And do you anticipate those interest rates will stay higher? That seems to be the theme at the moment. We're not going back to the kind of very long period where basically you didn't get a return on those assets.
Yeah, for 20 years we didn't have an interest rate. I think it's different, isn't it? You know, you get the sense that interest rates will remain elevated in the US for a while to come, for all the reasons that you talk about every day. Interest rates feel like they'll drop in Europe. So it's different, I think.
I think, John, this might be the last time we speak to you about full-year earnings.
It might be, yes.
It might be. And so how do you feel about the state of the City of London, the state of Lloyd's, as you present the last full-year earnings report?
I'm bound to say, I feel good about both. I feel good about Lloyd's. You know, in the last 6-7 years, we've grown by 50% in terms of revenue. The profits, as you've seen in the last 2 years, have been really very good. I think we're massively valued. You know, globally, you know, we're recognised as an unusual marketplace. We trade in 200 countries. We're a trusted brand. And we really do, per the conversation we're having, understand risk. We're valued. So I think we feel good. I think London feels OK, actually. UK feels OK, he says quietly.
Quietly.
Yeah, whisper it.
OK, whisper it. OK, John, thank you very much. Lloyd's of London CEO John Neal joining us once again on the programme. 7:50 here in London. Let's talk about where we are on the markets. 10 minutes until we see the start of trade here in Europe. Let's have a conversation about that with our executive editor for Markets Live blog, Mark Cudmore. Very good to speak to you, Mark, once again. We're coming off a Fed decision that sent stocks higher. US futures look as if they could go a little bit higher as well. Stocks could go higher once again. Does that make sense based on what we heard, based on the use of the transitory word from Jerome Powell? Mark, what do you make of the market reaction to the Fed?
I'm going to sound a little bit contradictory here, but I don't think it makes sense, and yet I think it continues. And what I want to explain by that is that the Fed sent a message that they were very concerned about growth. That was their big concern. And I don't think that should be a particularly reassuring message for stock markets, even though that's the yields are slightly lower. But I think that it's that idea that they didn't say that they were hawkish. They didn't say that they were more worried about the inflation impact, and they didn't kind of drive yields higher, has provided relief to a stock market that's been really sold down recently. And given that the data calendar is quite light into next week, I actually think that the next week we'll probably see US stocks continue to recover a bit of ground. This does not change the longer-term fundamental story. We always said that the Fed would be a short-term trading thing for a few days. It wouldn't change the macro picture, and I expect that to be the case. The short-term impulse is lower yields, a steeper yield curve, and perhaps a little bit of relief rally for stocks.
Mark, are we just in a holding pattern until April the 2nd? I've had two conversations with market strategists this morning. Both are telling me, to your point, maybe about the short-termism that we're seeing in the market at the moment, that we're just waiting. We need to wait until April the 2nd, and then we get clarity, hopefully, and we can move on and price it from there.
I think you're kind of right. I'd phrase it a little bit differently. I don't think that we're waiting for April 2nd to give us a new direction. We're waiting for April 2nd to kind of tell us how bad it is. I don't think the underlying trades we've seen so far this year are going to change. Part of the reason I think this is such a wonderful year for macro is we're getting trending markets and very understandable trends and very tradable trends. I just think we're getting a bit of relief rally before then, a bit of consolidation. So in that sense, it'll feel like we're waiting till then, but that's not going to change the picture. And I also think people who are waiting for April 2nd to suddenly provide a new direction or clarity are going to be sorely disappointed, because we've already had very strong indications that, yes, while we'll know much more about what's going to happen on the trade side on April 2nd, it's not going to be the final date, because we know already that some of the tariffs will come in immediately, some will come in with a delay, there'll be some kind of review period for others. So yes, it'll just be another marker in the trade path, not the defining moment.
Yeah. The dollar rallied into the election stateside, Mark, and then it continued to rally into January. Sometime middle of January, it turned tail quite quickly, and we started to see a bit of a retreat in the dollar. I'm looking at the Bloomberg Dollar Index here. We're seeing a bit of a bounce in the dollar. Is that sustained? What do you make of the moves in the currency, which, of course, has such an impact on the rest of the world?
I think the dollar rallies from here might be a little bit tepid. Well, will be tepid. I think overall the dollar is in a long-term decline. Short-term we can bounce a little bit. As I said, there are some short-term dynamics. The longer-term dynamics are, this is an expensive currency, and the world is structurally way too overexposed to the US. And that's the theme that we're going to see over the next couple of years. People decreasing their exposure to the US, and therefore we're going to see the dollar decline as they see those outflows come out of the country.
Mark Cudmore, thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore joining us. You can get the rest of the team's commentary. You can get Mark's commentary. MLIV Go is the function on your Bloomberg terminal. At the moment, we've got a fairly mixed picture emerging out of Europe. US futures are still fairly positive. Doesn't feel like the market's kind of really got anything to hang its hat on, though, this morning. Yeah, it doesn't really. And looking at some individual corporate names, not a huge amount in there. Lanxess, we might see some movement there. Sanofi. We'll bring you back the market open on the other side of this break. This is Bloomberg. Thursday morning, good morning. Couple of minutes to go until equities start trading here in Europe. I wouldn't expect fireworks if I was being honest. Let me just give you a steer out of yesterday, and then we'll talk about actually what futures are telling us right now. White line is Europe, blue line is the United States. We go out here, the US is down here. There's a little bit of a rally after that, and then a fade. I'm not sure it actually gives us much, and actually what futures are telling us right now is actually a fairly negative picture. We've got a sort of post-Powell story we need to price in. US futures were a little bit more positive. They're fading that move, I think, right now. But at the moment, we're looking at Euro Stoxx 50 futures down by 0.1%. FTSE's the same. DAX is absolutely flat as a pancake. You may get a little bit more activity coming out of the CAC 40 this morning. We're also slightly light, if I'm being honest, on single stock stories to provide us with a catalyst. Are we going to have to wait for a bit more of a steer out of the United States later? Are we going to get more from Donald Trump? Are we going to get something out of the Bank of England, the Riksbank or the SNB? There are still events out there this morning, but Anna, feels like a quiet start this Thursday morning.
It does, it does. It often feels quiet before an SNB meeting, and then sometimes we get news, so we'll see if that happens. Let's have a look at some of the individual names that could be on the move this morning. We have had a few corporates reporting this morning, and so we could see some movement in these. Sodexo is one of them, cutting their full-year estimates. Weaker in the United States seems to be the big takeaway here. This is the provider of catering services, of course, to some really big businesses and government organisations stateside, Europe, elsewhere. Lanxess in the chemical space. This business, interesting. They've had a really strong year to date, but they've missed the 2025 estimates that analysts have previously been penciling in. So we'll watch that and watch the chip story around that Nvidia report in the FT. We'll see if we get any movement there, Guy.
Absolutely. OK, here we go. Market open this Thursday morning. As I say, don't expect fireworks. Let's show you some numbers. The opening trade is upon us. I give you a drum roll, but it's a very limited one. FTSE 100 doesn't know what to do. It's in and out of positive, negative territory. Nothing to see there. The IBEX comes out of the gate absolutely flat. Look at that, unchanged. Nothing going on there. The Stock 600 is up by a whopping 0.01%, folks. This is an exciting market open. I'm struggling maybe to provide you with something useful to take away from all of this. At the moment, basically, I think the market's sitting on its hands. We've got through one volatility event. That was the Fed. Is this an indication maybe that Powell did what he hoped maybe he would do, which was leave the market reasonably unmoved by his actions? Well, if that was the case, then Europe is certainly giving him a big tick in the box on that one. We have got nothing here. Anna, save me with some sectors and some single stock stories.
Well, I'll do my best. I'm not sure I can oblige. Let's talk about the sectors story, shall we? So food, beverage and tobacco is the best performing sector this morning. So that doesn't sound all that cyclical, does it? So that's the best performer. That's up around 0.5%. But we do have around 2/3 of sectors in positive territory. Futures have been suggesting we'd be pretty flat. We are pretty flat. One of the movers to the downside I see, though, is Compass Group, and that, of course, competes with Sodexo. So there does seem to be some movement coming through in the companies that supply catering services, and that warning about the United States. We'll see how far that travels. Does that stay within the catering sector, or does that go elsewhere? But Compass Group is down by 3.6% this morning. So that's what we're seeing there in terms of the sector's picture.
Tech is up. So maybe we did call that one a little bit correctly. SAP, in terms of points, is adding the most this morning. It is up by 1.1%. ASML is up by 0.9%. But elsewhere, the sector story, I think, as you say, indicating quite a lot of mixed views in the market this morning. In terms of the breadth and what we're seeing this morning, you've got 362 stocks up. You've got 207 that are down. So on balance, maybe slightly positive. The market is up by 0.04% when it comes to the stock 600. So maybe slightly positive, but I'm not sure there's anything clear that you can discern in terms of what we can take away from that. I checked my sheets on what is happening with the 52-week highs and 52-week lows. There's a few out there. The banking sector is delivering a few, but there aren't as many as I would normally see on this board. And, yeah, you've got a couple of banks. Heidelberg is up a little bit. Technip is up a little bit. Aviva, actually, in the insurance sector, there's a few. But elsewhere, again, I struggle to provide anything concrete to put out there.
Yeah, and there is that movement on Compass. I was just looking at Sodexo. That is actually halted. So there does seem as if there's some downside movement in the catering sector.
Catering is our sector this morning.
It is our sector this morning. I mean, everyone needs breakfast, Guy, and it's just gone 8 o'clock here in London. So this feels incredibly appropriate to the time of day. Lanxess was the other one we mentioned, actually, ahead of the open. So credit to the team there, because that one is down by 2.8% this morning. So we have found some interesting themes and stories to trade around. But the biggest move actually on 3i in London. This is on the stock 600 and Process. Both of those down by more than 3.5%. Let us, though, put to one side the movement we're seeing in markets, such as it is this morning, because there isn't a huge amount of it. And let's instead focus on what we heard from the Fed, how investors are responding to the Fed and what that means from here. Let's listen to how some guests on Bloomberg TV have been reacting to the latest commentary from the Federal Reserve.
Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of one rate cut for today, and so far at least that fear was alleviated.
The market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity.
So it was dovish, it was hawkish, it just wasn't as hawkish as expected. Many views there. Takes many to make a market, of course. Let's talk to Madeline Ronner, Global Equities Portfolio Manager at DWS. Madeline, nice to have you with us. What does any of that mean, then, for your allocation, or your allocation to the United States versus other geographies, your sectoral allocation? Anything you heard yesterday that moves the dial for you?
Thank you for having me. So actually, I think yesterday we didn't get too many news. I think it was very much still the expectations that we will see roughly 50 points cuts this year. I think this is what he delivered. I think he managed it very well to calm markets a little bit in this very uncertain environment, to see either way how tariffs are going. We have the situation handled. Yes, there was some, I think, worse messaging probably on the growth picture. So I've also heard some thoughts around stagnation probably being thrown around again, which could be more on the negative side. But generally, I would say this was not needle moving for our positioning.
OK, and how much are you seeing money moving into Europe given what we're seeing in the United States with tariffs, given what we're seeing with fiscal expansion in Europe? How do you characterise it? Because some people are saying what we've seen so far on European gains is just people closing shorts and turning a little bit less negative than they were. We haven't necessarily seen the next leg of gains. How would you characterise what we're seeing in Europe, Madeleine?
Yeah, so I mean, for sure, going into the year, generally Europe was an underweight for many active funds and investors generally. And that has started to shift a little bit with the growth picture in the US being a little bit more dampened, and the growth picture in Europe actually picking up. However, we still like Europe structurally. We had an overweight going into the year, and we're keeping that. But tactically, for the next few months, I think the market currently is a little bit underappreciating the risk when the tariffs come to Europe, when Trump's focus on tariffs come to Europe. I think there is a risk of this escalating, which I don't think is priced in markets. And let's also not forget that a lot of European companies make a lot of profits in the US, and the European economy, despite all of the fiscal stimulus, is still very much dependent on what the US does. So if the US growth just slows, I think the fiscal package can really help to accelerate growth and make Europe more attractive again structurally. However, if the recession risks obviously in the US have increased, and if that were to happen, I think it's very hard to get a positive picture on Europe as well. So it's a little bit mixed right now, but longer term, this is really the fiscal policy shift is really, really historic. So there is a lot to get excited about in Europe.
So, Madeleine, do I buy dips in Europe if I see them?
Depends on the scale of the dip, but generally I would say yes. I mean, if you look at the valuation gap to the US is still on historic highs. It has closed marginally, but not by much. But if you look at the valuations, for example, in the German DAX against its own history, it's not that cheap anymore. So, but obviously, earnings estimates might be revisioned positively as well. So, if we see some dips on trade policy, which I hope at least will not be permanent, then I think this could be again buying or entry opportunities into a structurally more attractive market. Because let's not forget also in Europe, the consumer generally is quite healthy, right? The consumer balance sheet, it has been more consumer confidence and the willingness to spend that has held growth back, right? It's a different picture in the US. There the consumer is much more stretched also from a balance sheet perspective. So if we can really start to get this going, I think Europe does have a lot of potential.
Have there been sectors in Europe that you think have become far too stretched? Defence is the one that instantly springs to mind. The market has really focused on that defence story, and I'm wondering if that is where the risk really lies, that the reality of what Europe can do on the defence front maybe is overpriced into some of these key areas.
So I think the first thing I would say, I would caution on the valuation side to look at like 12 months or 20 months forward earnings and PE ratios. I think that can be misleading because for once the earnings estimates have not been caught up yet. So you need to do your own work on what you think the earnings power can be for those companies. And I really think the market is currently focusing more on the structural opportunities. So what is the earnings power in 2030, 2035? And then you need to discount that back. And I think for that, there is a lot of potential here. However, as you mentioned, like one of the large problems right now is capacity. Like how fast can you ramp this up? And I mean, Rheinmetall talking about repurposing VW plants is showing this this problem quite nicely. And there might be some ways to do that, but that might be where the market could be a little bit disappointed on how fast this goes, because defense and infrastructure spending also on the fiscal package, let's not forget, that takes some time until it works, right? So we are not expecting a large shift to growth this year. We expect like the first incremental points of GDP growth, like 0.5% to start next year from that package. But it will take some time until this really gets going.
Yeah, Madeleine, I wonder what's priced into markets. Is it possible to say at all what's priced into markets when it comes to tariffs? I'm thinking of Europe and what kind of reaction function we'll see in stocks when we see the facts around these tariffs. Of course, we'll see percentage tariffs, we'll see what they're applied to, we'll work out what percentage of the economy, which companies are affected. All of that will have to be done. But do you have a sense of what we're assuming already, so that when we see the numbers, we'll have a sense of whether this is good or bad news versus expectation?
So I think if it only comes into place what is currently announced, that looks to be fairly expected and priced in, and would not be it would be a drag to growth, but it would be like a huge disastrous thing. However, I think the real risk really lies that this escalates, and we've seen how erratic it has now kind of happened with Canada and Mexico. So I think there is really a risk that if the EU retaliates, that Trump kind of over-exaggerates on some retaliatory measures on the US side. So, and I really think if that happens, that obviously is not priced, and there is little risk priced into that and to the markets right now. So that would be my main focus. So if we will see some kind of stabilization starting out of April, and I think markets will need some kind of 1 or 2 months or 3 months even of that to be stable to believe it, that really nothing is going to happen afterwards. But I think that's kind of unlikely. I think we will see kind of a back and forth, and it will really have to see on how it goes and on the spot. It's so uncertain right now, it's very hard to tell.
Madeleine, great to catch up. Yeah, uncertainty seems to be the phrase that or the word that everybody is using right now. Madeleine Runner, DWS Global Equities Portfolio Manager, thank you very much indeed. Core 6 looks like this. Little bit of a bid, maybe into some of the technology stocks that we've been watching this morning. As you can see, ASML is up by 1.3%. Elsewhere, a very, very mixed picture out of Europe this morning. No clear sense of direction. So let's dive into something that is at least on the menu, and that is what is happening with the food stocks. Joe.
So catering stocks, Guy, really the sector in focus today. Take a look at Sodexo over in Paris. We're down around 13% on that stock. The company warning of weakness in North America, specifically in the healthcare and education sectors, two of the key sectors that they supply to. And this is interesting to me because yesterday we had a downgrade for Compass by Exane analysts. They warned of exactly that, weakness in the US in those sectors. One stock that I think is interesting, also dropping, Pearson, the education company focused on the US. An interesting read across from that, given the warning around that sector. Then in terms of chemicals, that was looking a little bit weaker as well. The numbers out of Lanxess, that was the old spin out of BASF, or actually I may be getting my Bayers and BASFs, I'll have to check that one up, but it was a spin-off from one of the old German companies, and that stock weaker today and actually feeding through into some of the other chemicals companies, but only down around 5%, not as bad as the catering issues on that one. Then in terms of the financials, Prudential, that one a bit stronger. We did have results out of the insurance company over in the Asia trading overnight, but listed in London, of course, it is doing well on life insurance, according to the firm there. Then there was a second-day reaction for Prosus. Now, we had Tencent numbers hit yesterday. Initially, a strong reaction for the Dutch-listed stock that is the biggest investor in the company, but overnight, the sentiment soured on Tencent, and that feeding through into Prosus this morning. We can see that down as much as 3.7%. This morning. Then Covent Garden in the headlines because Shaftesbury Capital doing a big deal, $2.5 billion, potentially £1 billion in terms of a deal on selling a stake in that, a 25% stake in Covent Garden, with that big valuation coming through for the asset there, 13% gain for Shaftesbury today in London. And finally, on the ratings changes, Lloyd's is upgraded at HSBC. Now, they've been hold rated for 4 years. Since 2020, they've had a hold rating. Finally, they say it's time to buy Lloyd's, given the company seeing better than expected returns. And that one outperforming very slightly in London. Lloyd's only up 0.2% today in a pretty calm market this morning.
Joe, thank you very much. Joe Easton from our equities team. So catering companies, the story in town this morning. How many ways are we going to find to talk about that in the next 45 minutes, do you think? How many more puns on food?
I think, let's move on. No more.
No more. We're done with those.
We're done with that. Let's talk about Nvidia. The stock looks like it's open pre-market now, and it is up. This, as we see this FT report, certainly causing waves. It seems an indication from the FT reporting that we are going to see Jensen Huang spending significant amounts of money in the United States. He's basically saying, I want to manufacture chips in the United States. He's talking about using fabs provided by TSMC and other companies to provide these chips. But it's basically a big onshore move that we are going to see rippling through. Part of the chips narrative that Biden pushed through, certainly part of the onshoring narrative that Trump is pushing through as well. Nvidia is up by 1.7% this morning. Nike, pay your money, take choice on that one. Also tracking a little bit higher. We'll watch for that one a little bit later. A big move back into sports and kind of elite athletics, and that seems to, or elite athletes, and that seems to at some point that will have an effect. Will it show up in these numbers? We're also seeing Rivian being downgraded this morning. Piper Sandler downgrading that target to 13. We are already below that, it looks. The stock is going to be down by 1.94% this morning, judging by the pre-market that we're watching.
OK, coming up on the programme, we'll talk once again about defence. EU leaders are meeting today to discuss plans to bolster defence spending. We'll take a look at some of the businesses that are well positioned for all of the money that is going to be spent in Europe on defence. We'll do that with Benjamin Heelan from Bank of America Global Research. We'll talk about the companies that are going to be making the things that Europe wants to buy here. This is Bloomberg.
Is really needing to ramp up, get its act together, and show that it can deliver.
So you need to protect your airspace, and it's very visible in Ukraine.
The actual thought that Europe needs to start to get their act together.
The budgets that are under consideration is a plan for the next decade to rearm Europe.
We need to step on the accelerator. More money needs to be available, and it needs to be especially, the procurement needs to work faster.
Need more of everything and of a better performance.
Move at least 10 times faster, and the scale needs to be better in shells, missiles, armored vehicles.
Seize of weapons in Ukraine will not erase the Russian threat.
The whole defense kit that the current industry manufactures is just outrageously too expensive. There's still a lot of the old red tape around.
It would be a great risk if we stop those investments just for the sake of the ceasefire in Ukraine.
The US are never willing to rely on anyone else than the US, and the US is right. Why Europe should do different?
CEOs of several European defence firms talking about the arguments that they are having right now about how the region needs to cut red tape, deal with its procurement issues faster. Go, go, go seems to be the narrative. So today we're going to see maybe some evidence of that becoming reality. EU leaders, there's a council meeting taking place today. They are going to be discussing bolstering defence spending plans. We saw early indications of this, obviously, yesterday in terms of the size and scale of the plan and the fact that it's going to be ring-fenced in Europe. The US administration clearly looking in a different direction right now. So we've seen a massive rally over the last few months in European defence stocks as a result of all of this. Ben Heelan is the co-head of developed EMEA Aerospace, Defence and Capital Goods at Bank of America Global Research. Over the last few days, the team has been hosting its Global Industrials Conference in London. It's brought together over 650 investors, 80 companies, and many of them are defence companies. And we've been getting a good idea of how they feel about the world as a result of this conference. Ben Heelan joins us around the table this morning. What was the takeaway?
Look, I think the big takeaway was that companies have been growing for 3 years, right? We're 3 years into this from a Ukraine perspective. But what's happened in the last 2 months has just increased the duration of the investments that we're going to see in Europe. There's obviously this buy European narrative, which is clearly gaining a huge amount of traction. And actually, I think, you know, when we think about a lot of the companies' medium-term growth trajectories that they've given, we're going to see a steeper growth trajectory, but for a much longer period of time. As an example, we had Thales. I saw you had Patrice on the program last week. We had Thales yesterday, and they were saying we could grow for 20, 25 years, given the amount of visibility that we have. So there is clearly a lot going on in terms of negotiations with governments and companies. What can we provide? What capabilities do we need? I think we'll see more colour of that coming in the next couple of months. But it's very clear that Europe is going to be a structural growth market for defence for the next 10, 15 years.
Do I just buy these stocks at current prices, put them in my back pocket and leave them? Or are we in a kind of near-term overbought kind of position? Are there going to be better entry points coming? Or is this as good as it gets? And as you say, the long-term picture looks good.
No, I mean, look, one of the big questions I get is what happens with a Ukraine ceasefire, right? And I think that a Ukraine ceasefire that means that Ukraine would lose that territory and isn't able to get that territory back isn't going to change why Poland, the Baltics, Finland are investing in defence. So I think those fundamental drivers of defence are still there. And if you look at some of the numbers are very stark, right? Germany's procurement budget could go from 9 billion euro pre-Ukraine to 60 billion euro in 2030, right? And so when you put the Rheinmetall move in context of that explains why Rheinmetall has moved where they are. So we actually see still decent amount of upside across all of these names. The big debate from here is going to be the ramp. How quickly can you ramp? And what share is Europe and other companies going to get of these increasing defence budgets?
Yeah, Ben, good morning. So in terms of that ramp, how supply constrained are these various businesses? Where is that not an issue and where is that holding them back?
Yeah, so I think, again, we're 3 years into this. So Thales, as an example, has hired 30,000 people in the last 3 years, right, for its defence and aerospace business. They had 1 million applications, right? So finding people, I don't think, is going to be the constraint. It's going to be getting those people in the business and training them. That's just going to take some time, right? So there's the easy wins, which is kind of adding an extra shift, right, adding an extra, shift and a half, etc. So you can see an increase in capacity, I think, relatively quickly over the next couple of years. And companies have been planning for growth, right? So it's not as though the companies haven't been making investments. But I think what you will need is the governments over the next 2 to 3 months are going to have to decide what capabilities do they want, what scale do they want, and we're going to see the contracts come from the governments, provide visibility, provide prepayments, and allow those companies to go out and make investments. You know, Rheinmetall talking about taking a VW facility and repurposing it. That's great. It's going to take time to do that, and they need the visibility. And I think that's one of the big changes that we've seen in European defence. It just hasn't had the visibility for 10, 15 years.
Okay.
It has that now.
Ben, this sounds, in some senses, quite simple. 10 to 15 years, structural growth for this sector. What role do you ascribe to NATO in all of this and all of that complexity around what NATO means now?
Look, I think NATO is still the bedrock of European security, right? But I think what we've realised here in Europe, and I think what the leaders have realised, is that they need the capabilities to do things themselves, right? And there are a number of capabilities that Europe has just come extremely reliant on the US for, whether it be things like rocket artillery, whether it be things like missile defence, F-35 and stealth. Those capabilities don't change overnight, right? We can't change those things overnight. So I think what we're seeing is Europe recognising it needs its own defence industrial base. It needs to take control of its own security. But I think NATO, and we'll see with the NATO summit, and we've heard from Mark Rutte as well about, the spending requirements, etc. I think that summit in June, we will see that NATO is still core to European security.
The French want Europe to buy Europe. What does Europe mean? You break out any piece of equipment that an OEM puts together, it's got all kinds of bits in it, and that's a problem. Where does the UK sit in that? What happens with BAE Systems? What happens with Babcock? What happens with these kinds of companies? Do we yet really understand how this is going to work from a political point of view?
Well, I think the Buy European mandate is to correct that capability and defence industrial base gap that we have with the US. So I understand why France wants to spend the money in France and Germany on the European continent. And France is a good example because pretty much all of French defence equipment comes from the defence primes in France, whether it's Thales, Airbus, Safran, as an example. What does this mean for BAE? You know, BAE has a sizable European business, right? It has a big Scandinavian business. We hosted Charles on Tuesday, the CEO, and he said he would be open to M&A in Europe. But the UK has talked about going to 3%, and so BAE is a big UK business.
Yeah, we'll certainly watch that story as it develops. Ben, thank you so much. Ben Healing, co-head of Developed EMEA Aerospace Defence Capital Goods at Bank of America Global Research. We'll get back to the central banking narratives shortly. SNB and Riksbank on deck. This is Bloomberg. Welcome back to the programme. We're getting a decision from the SNB, the Swiss National Bank, cutting the policy rate by 25 basis points to 0.25%. The estimate was exactly that, so we had been anticipating this, although UBS had described it as a coin toss. Would you want to use the limited room you have between where you are now and zero to... would you want to use it now, was the question that some were asking, because growth's pretty resilient, there's limited space to cut rates down to zero, and the Swiss franc's been weakening already. So those were the questions being asked as to whether we would get this move, but we have seen a move then in from the SNB. They're also telling us a little bit more about where they see things heading. They see 2025 GDP growth 1 to 1.5%. They remain willing to be active in the foreign exchange market. So interesting that they've decided to go now with this cut when they could have decided not to.
Are they done? Is that it? Is that it? the cycle is over. We've gone as far as we're going to go. We're not going to go below. We are kind of at the limits now.
Yeah.
Of what is possible.
And for as much as this was anticipated, we're seeing a spike in the currencies. So it certainly wasn't all built in.
Yeah.
There's some people who had expected that we might get a hold here and they might keep their powder dry. Valerie's been tracking this. She's been tracking the Riksbank. She's, of course, all over the Fed story. Let's bring her into the conversation. Valerie, the SNB then. So you need to be ready to be surprised by the SNB, which has happened in the past. I don't know how you define it. No, I mean, the expectation was that we would get this, so no. But the FX market seems to have... Not everyone was positioned for it.
Yeah, the S&B is known to surprise. It was only last December they had a 50 basis point cut, which surprised markets. But look, I think maybe the market's moving because there were a few factors at play that would argue in favor of a hold here from the S&B today, one of which being tolerable low inflation, okay economic growth. Fourth quarter GDP for Switzerland came at a 2.5-year high. And most importantly, the franc really hasn't appreciated too much. So there really wasn't, I guess, an urgent need for them to cut. But the S&B only meets 4 times a year. And I think the worry for them is if they did see a resurgence in franc strength on the back of, a risk-off move around trade tensions, that would hurt their export-driven economy, which is also focused on pharmaceuticals. They make up 35% of the exports in Sweden. Trump has talked about pharmaceutical tariffs. So perhaps the cut today in some way guiding against any further franc strength to come.
I see your SNB. I raise your Riksbank. It is also, it seems, maybe on hold from here, and is actually guiding maybe a little bit more explicitly that is the case. Assesses the rate path will remain at this level going forward. Nothing to see here. We're going on holiday.
So there was some speculation that we could see more clear guidance that maybe the next move is a hike. There was an unexpected surge in inflation in Sweden recently. Fourth quarter growth came in strong as well. So we didn't necessarily get strong language that the next move is a hike. Instead, they've just said that we remain on hold going forward. We do get some more guidance from them in terms of their rates, their GDP and their inflation forecasts as well.
So what they're saying is, so this is interesting. Outlook for inflation and economic, the outlook for inflation and the economic story largely, quote, intact, but uncertainty abroad is unusually high.
Yes, we heard that from Jerome Powell, but he wasn't talking about abroad. He was just talking about uncertainty. This seems to be a theme that many central bankers will return to.
Yeah, well, I guess the question for the Fed is, if uncertainty is so high, does that mean you cut, or does that mean that you stay stable and stay where you are? And I think Jerome Powell's answer yesterday was uncertainty is so high, so we're not moving. We need to wait for more clarity, which I know you guys have talked about. Is that hawkish or dovish at the end of the day if they intend on holding rates steady?
Absolutely. It depends on where you start from in terms of your positioning, whether or not you view this as all as hawkish or dovish, I guess. But I think the real takeaway from me yesterday, he's basically saying the dots, we don't know, so the instinct is not to move the dots. There's always this kind of assumption that there should be some activity.
Yeah.
We were joking earlier that the dots should be actually emoji. Should they be kind of happy faces or sad faces, depending on which kind of way you see?
Yeah, so even if it doesn't move, there's some emotion expressed by the dot.
Around the dots. The dot needs to have added emotion.
Ingenious idea, Guy. You should propose that to
we thought it was a little too Gen X, though. It might not go down too well with a forward-looking Fed. But any other takeaways in terms of the broader picture then, Valerie, as to what we heard from the Fed? Because clearly, yes, there's a huge amount of uncertainty about what tariff policy is going to do to inflation. And Jerome Powell was very cognizant of that and acknowledged that very openly. They really don't know how much of any uptick in inflation is being driven by tariff threats.
Yeah, he said that a few times. So, yes, we upgraded our inflation forecast, but I can't give you a breakdown of what's tariff-led inflation versus not. And he actually had a funny quiff about that. He said in the last round of inflation, there were tariffs on washing machines. But we also saw prices of dryers increase. So there's a lot of funny things that happen around inflation and tariffs. They're not sure how it's going to work its way through an economy, so they're going to stay stable. But
it's an interesting one.
We did see it in there.
Something about a spin cycle. There's got to be something about...
No, I was just going to pricing power. I think, if you make washing machines, you also make dryers. Maybe a tariff on washing machines gives you more pricing power around your dryer.
Yeah.
I mean...
Yeah, so, you know, the possible effects of inflation due to tariffs, is it going to be persistent or transitory? If you look through how they upgraded their inflation forecast, it gave a big bump to this year, but they see it coming down in the years afterwards, which is another hint that they think it's transitory.
So there's a constant spread between washing machine prices and dryer
This is going to stick in guys' mind now. This is now his daily obsession.
But it's a very interesting fact, I thought.
Yeah, no, it is. I am stunned that he is ready to use transitory.
Yeah,
I have excluded that word from my lexicon in terms of I think we should ban that word. But Powell clearly feels that it's still a word that he can use.
Or it just shows us that he's more concerned about the downside risks to growth from these tariffs rather than a resurgence in inflation. So
I would have thought he would have come up with another word. Is really my point.
Yes, yeah, that one's got some bad connotations.
But I suppose maybe he just wanted to use it like any other word, so it didn't take on this meaning.
Yeah,
yes,
quite possibly.
I still want to use it. It doesn't have bad connotations for me. We've just had a couple of central banks basically talking about the uncertainty that exists elsewhere in the world. Valerie, thank you very much indeed. Let's talk about what we're seeing in terms of the UK, because this is going to be represented, I suspect, with the Bank of England as well. UK wage growth holding at its highest level in 9 months. The data, we saw that this morning. Unemployment ticking a little bit... employment ticking a little bit higher. The Bank of England out with a decision a little bit later on. We're not going to get a press conference. We get a statement. We get a little bit of detail, but not very much. So let's look ahead to what we can expect from the Bank of England. Lizzie Burden joining us on that. Lizzie, talk us up for this midday policy announcement. How much detail are we going to get, given the uncertainty that exists?
Well, you talked about the wage data that came out this morning, Guy. That's not going to give much confidence to the people in there when it comes to this decision and the policy making ahead. The bottom line of it all is that the labour market is still tight, and caution really has been the watchword ever since the last vote. Even, you know, you had Dave Ramsden, Deputy Governor, very much seen as a bellwether on the committee, him calling for caution. Even Catherine Mann, who, of course, surprised markets by going from arch hawk to arch dove, voting for that jumbo cut. Even she is now emphasising the need for policy to remain restrictive. So I think they will keep the guidance that it needs to be gradual and careful going ahead. Careful, the word they added at the last meeting, because of all of that uncertainty you were just talking about in terms of Donald Trump's trade policy. But there's also worries here about the impact on inflation expectations and the second round effects in terms of wages and prices. But as you say, no press conference today, no updated forecasts. They might hint that the growth and inflation outlooks at the moment are too low, but markets currently pricing in 2 more cuts for the rest of the year. At the moment, it looks like the Bank of England is going to be more hawkish than the Fed, and that's why this week you've seen the pound popping above that $1.30 level.
Yes, so take us to next week then, Lizzie, because we get from the Chancellor a spring statement, and I think this months ago there was a hope that this would be a bit of a non-event because we'd already seen some big tax rises in the budget, and business had been very outspoken on that, and so hoping that this would pass kind of smoothly and unnoticed. But as bond markets have done what bond markets do, the pressure has built.
Yeah, and of course Rachel Reeves made the promise that she was only going to have one fiscal event a year. It looks like this could be more significant than she'd planned back in October. Interestingly, I was speaking to her on Monday, as you know, and she hinted strongly that she understands the need to build up a fiscal cushion again. She only left herself £9.9 billion of headroom against her fiscal rules in October. As you say, Anna, that's now been eroded. And we have had it confirmed now, our colleagues on the government and economics team, Phil Aldrich and Joe Mays, that indeed that headroom is going to at least stay the same but maybe go up. She's ruled out more tax rises. She's ruled out breaking her fiscal rules. So it looks like it's going to come from spending cuts. We already know that there are going to be cuts to the welfare budget, to the aid budget to fund defence, that they're cutting the pensioners' winter fuel allowance. So to many, this looks like the sort of thing that a Conservative Chancellor would do. And I think what's most fascinating is it seems Rachel Reeves is more worried about the bond vigilantes than she is about the left wing of her party.
Lizzie, thank you very much. Lizzie Burden outside the Bank of England. We'll bring you all of the details and everything that goes with the Bank of England rate decision later, not the press conference. Isn't one this time around. We're hearing from the banking sector in Germany.
So there's this Morgan Stanley event that's taking place currently. We've seen a series of CEOs over the last few days speaking at it. Bettina Orlopp speaking right now. I just want to give you a little bit of context, though. So UniCredit's Uchel has been speaking as well over the last day or so. He says that basically he can sit and wait for Commerzbank until 2027. So he's giving this deal a long time to come to maturity, his acquisition of that, were it to go through. Bettina Orlopp is out this morning talking about the fact that she basically treats Uchel like any other shareholder, regular contact, but nothing kind of extraordinary. The line that really stands out for me in what she is saying is that basically we need banking union before we can get cross-border M&A. So basically she's pitching it back towards the politicians and saying, and this is on the agenda today at the council meeting, get banking union done and then we can get cross-border M&A done.
Yeah, Christine Lagarde's been talking about the need for a single market. We've talked with a couple of guests this week about the need for capital markets union, or is it savings and investment union, whatever you want to, acronym you want to attach to it. So we'll continue to monitor that one. Commerzbank shares then down by 3.5%. Coming up, we will return to the EU Leaders Summit that's taking place. The subject is defence. We're seeing leaders arriving for that meeting in Brussels right now. The Dutch leader, the Dutch Prime Minister, is speaking currently. Dick Schoof talking to the media as we speak. We'll monitor that conversation and all the others as these leaders arrive. Trump's shift in policy, of course, top of the agenda. That's next. This is Bloomberg. Welcome back to the opening train at 8:45 here in London. European equity markets not moving all that far, up by 0.2% though now. So after early expectations set by futures, perhaps that we'd track a little bit lower, maybe we're turning tail and following the US futures picture a little bit higher. So US futures guy pointing up by 0.5% on E-minis. And of course, we'll watch tech names on Nvidia news.
Do you want to talk about catering?
Yes, and catering stocks have been doing quite badly in Europe. There we are.
There we go. Let's turn our attention to this morning's big take on the Bloomberg. Cheap Chinese goods are flooding emerging markets as President Trump's tariffs force manufacturers to look elsewhere to move their exports. Indonesia has lost roughly 250,000 jobs in the clothing industry over the last 2 years, while Mexico has seen large-scale job losses in its shoe and textile sector. Let's bring in Bloomberg's Bill Farris for more on this story. Bill, I'm curious. Trump hasn't been in for 2 years. He's only been in since the beginning of the year, and we've seen this effect over the last 2 years. So I'm wondering kind of what's really happening here? What is going on? Is this a bigger story that the tariff story is only accelerating, but a trend that was already in place?
Yeah, that's right. It's a great question. Some of this can be traced back to the first Trump presidency when he started instituting some of those surprise tariffs on China back in 2018. But then in 2020, as China started having problems with its property sector, you saw the country investing a lot more in expanding its manufacturing base. And that was both to increase a little bit of the domestic consumption, but to produce a lot more exports. But with the U.S. market slowly getting a little bit tougher in terms of tariffs and the disputes between the countries, China's exporters really began looking across the emerging markets for other opportunities out there. That was something you heard a lot about from Janet Yellen during the Biden administration. You heard some concerns about that from European leaders over the last several years. But now, facing a potentially new wall of tariffs coming in from the U.S., it's a trend that is really accelerating. So one of the things I think in that big take story today that's interesting is you see there were 250,000 job losses in the textile industry in Indonesia over the last couple of years. The industry there now warning that you could have 500,000 additional job losses this year alone as those tariff barriers climb.
OK, yes, and you get a sense then it gets worse in emerging markets, but perhaps also elsewhere, Bill, because the story focuses on the impact this has had on emerging markets. But as you say, European leaders have voiced concern about the same thing happening in Europe. So where do we get this sense that this worsens from here?
Well, you have obviously with if the tariff barriers are continuing to climb in some of the biggest markets like the U.S., that forces China to start looking elsewhere to send its goods. What we've seen is that China's total exports, its share of global exports, has basically held steady over the last several years, but there's been a real shift in where those exports are going. So sales to the U.S. Are not quite as high as they used to be, but they've made up for that by going to places like Brazil, like Vietnam, like Indonesia. Sometimes that is part of this rerouting of supply chains, so that if you can't directly export from China to the U.S., you can set up a factory in Vietnam and perhaps export from there. But some of it is also using those local markets, many of them in Southeast Asia, as your primary destination. And that's putting a lot of pressure on the local manufacturers across the region, across emerging markets, who really struggle to compete with that efficiency in the massive Chinese market that's built up over the last several years.
Bill, is China too big to fight? Can these countries push back in any shape or form?
It's a very tricky situation. So you have seen countries like Mexico talk about imposing some pretty steep fresh tariffs on Chinese imports. You've seen Canada talk about that. And it's something that's come up in other countries in terms of putting restrictions on, for instance, direct mail sales from China into countries like Vietnam. But the trickier part of it is that China is also, for most of these countries, one of their biggest foreign investors and their biggest trade partner. So, you know, if China is there investing in a major port or major infrastructure projects, these countries have to decide if they want to pick a fight over some of these lower value goods. I think the big question is at what time, where does the pain point come in? So in Indonesia, like we said earlier, you talked about 250,000 people perhaps having lost their jobs in textiles over the last couple of years. As that climbs, is there going to be more pressure on governments like Indonesia, elsewhere in emerging markets, to do something a little more serious to tackle this threat?
Bill, thank you very much. Bloomberg's Bill Ferry's joining us there from Singapore. Let's move on from tariff threats and how tariffs are reshaping the global economy to some of the other geopolitical policies coming out of the White House right now. In a call with President Trump, Ukrainian leader Volodymyr Zelensky has agreed to pause strikes on energy assets, echoing an agreement the US and Russia made just earlier this week. US Special Envoy Steve Witkoff says he's hopeful a full ceasefire between Russia and Ukraine can be reached soon.
On Monday, we actually have the technical teams going, and why? Because that's what we're down to. We don't need to have the larger overarching discussions. That's been had, and it was completed yesterday between the two leaders. They agreed on a pathway to some ceasefire conditions today and to a full-on ceasefire that will be negotiated over the coming days. I actually think in a couple of weeks we're going to get to it.
For more, let's go to Bloomberg's Oliver Crook, who's at the European Council building and joins us now. Ollie, you're there in Brussels, the European Council gathering, European leaders gathering to talk about their stance on Russia, on Ukraine. But I think the stage for further talks on Ukraine, those conversations actually, with the United States at least, happening in Saudi Arabia. So how do we look at Europe's role in these conversations now?
So I think Europe's role in these conversations is very much sort of catching up and basically getting briefed after these conversations occurred between Donald Trump, Vladimir Putin, and Zelensky as well. And basically what this European Council meeting is about is to get Europe into a position where in the future it will actually be a relevant player in these kinds of discussion. We have learned from the Trump era that basically power is no longer really garnered through these sort of diplomatic means, these old sort of alliances and these old sort of friendships. That doesn't guarantee you a seat at the table. It's really guns, ammo, and dollars, right? And that is basically what these European leaders are here to do. They are here to implement the plan that we got the outline from a couple of weeks ago from Ursula von der Leyen, the so-called Rearm Europe Plan 2030, which is basically trying to get the European continent in a shape to potentially fight a war in the next 5 years. So that includes a number of different things. That includes a large degree of loans from the EU. 150 billion euros have been put forward, changing the mandate of the European Investment Bank in order to enable investment in the defense industry, which is currently prohibited or is limited to dual use, redirecting some of the funds from the EU, obviously changing those fiscal rules, which are absolutely key to get sort of headroom at the national level, which is in part what allowed Germany to do what it did a little bit earlier this week, which we expect to pass here on Friday. But all of this to say, basically, and I think this is a sort of another interesting point that we heard from the sort of French, we can kind of count on the French to say the quiet part out loud in many of these discussions, basically saying that you would not only need to buy more military equipment, you need to buy more European, because if the United States is not a reliable partner, if they are sort of willing to use every every bargaining chip to get an advantage, then if you get all of your military equipment from them, military equipment, which, by the way, often needs American personnel to operate and needs software updates and these sorts of things, it puts you in a very vulnerable position. So a lot of the focus will also be in sourcing that out of Europe. Of course, and we've talked about many times, that will take, a decade or so to build out that capacity, but that is the conversation before European leaders today.
Let's talk about the transactional nature of what is happening in Ukraine at the moment. There's obviously the conversation around the fact that the White House wants access to Ukrainian rare earths. There's now a conversation apparently around power stations, though there does seem to be some uncertainty. The White House suggesting maybe that there's this power station conversation going on. Zelensky seems to be saying something slightly different. I'm reading a piece in the Frankfurter Allgemeine saying he only talked about Zaporizhzhia. Ollie, the UK Defence Secretary has talked about this being kind of already being a position where we are talking about this being kind of expropriation. We're talking about really kind of strong words being used. Just give us the lowdown on as to what is happening here.
So listen, it depends for what your perspective is. From many of the European perspective, and again, it's very difficult for anyone in any official capacity to say this stuff out loud. This is basically an extractive economic policy by the United States. On the other hand, the Trump administration and the U.S. would basically make the point that basically they need to explain to their taxpayers why they're sending hundreds of billions of dollars to a country that many of the people in the United States do not see a direct connection to their personal lives, and basically trying to recoup some of that investment. Again, and Donald Trump is throwing a lot of different things sort of, it seems, at the wall. There was, of course, the minerals deal. That seems much more concrete. And now this question about sort of energy assets. We got a little bit of a briefing of what that could look like from the White House press secretary. Have a listen to what she had to say.
President Trump also discussed Ukraine's electrical supply and nuclear power plants. He said that the United States could be very helpful in running those plants with its electricity and utility expertise. American ownership of those plants would be the best protection for that infrastructure and support for Ukrainian energy infrastructure.
Of course, running the power plants and owning the power plants maybe not are not exactly the same thing. The point that they're trying to make, however, is that American economic investment in Ukraine is the best kind of security guarantee. Of course, the point that the Ukrainians would make and have made on a number of occasions is that there were a number of businesses that already had financial interests in Ukraine, and that did not prevent the invasion, nor did it prevent the invasion of Ukraine. And this is the point that the Europeans are making as well.
Ollie, great stuff. Thanks for the update. We'll continue to update everybody as we work our way through the morning. Leaders are currently arriving in Brussels. So that's certainly one of the big elements on the agenda today.
Yeah, absolutely. Looking for what they have to say about sanctions, their attitude to Russia. Is there an increasing dividing line across the Atlantic there? Because according to the draft that we've seen, it looks as if Europe still wants to go tough on sanctions on Russia and stands ready to increase those. We've also got a Bank of England rate decision. Lizzie Burden outside there in the cold, looking for headlines there. Perhaps a little hawkishness creeping in from the BOE?
A lot of uncertainty seems to be coming out of European central banks this morning. We'll see whether we get a similar story coming out of the Bank of England. We'll bring you live coverage of that as we get to that at noon. That's it for us. The brief is next. This is Bloomberg.